Good evening and a warm welcome to everyone. I hope I'm audible to everyone, and I would request if you could confirm that, please. Thank you. So we'll just wait for a minute more. There are participants who are logging in, and we'll start after that. Good evening, everyone, and a warm welcome from AIWMI team and from the Edelweiss team. My name is Anand Lalla, and I'm part of the Edelweiss Asset Services, hosting this webinar today on the recent PMS regulations, the changes in the PMS regulations, which have been proposed by the working committee team and should be implemented going forward. I'll quickly give you what we'll do is that just for the benefit of all the participants who are new to the portfolio management services regulations. I am assuming there would be many participants who already have a portfolio management service and are looking forward to understand what are the proposed suggestions or the changes uh, on the regulation side, which might happen in due course of the time. So, what we will do is that we'll quickly cover the current regulations as they stand right now. We'll give you a brief on that. And post that, I have my colleagues Shailendra Sharma, who is from our products team. He has been a specialist chartered accountant by profession, and has been working as a consultant. Has been working as a consultant in his earlier avatar. We also have with us Krishnan Nair, who heads the fund accounting services, and he will take care, or he will explain you on how the reporting or what will change going forward in case if there are suggestions which might get implicated. What are the necessary reporting changes which PMS needs to keep in mind. So I'll quickly give you a brief on the current PMS regulations. What is a PMS and where it stands right now? So what you see in this slide is basically the operating guidelines. I'll just cover each part very quickly. So the idea of a portfolio management service is basically to pull in money from any investor and manage the money by an experienced portfolio manager uh, who would have basically been in the industry and has been expert in managing money for the clients. So it's basically a tailored model portfolio for the investors who focus on absolute returns rather than market performance, and would basically over a longer period of time outperform the benchmark. Now, the portfolio manager who wants to start a PMS or who would be managing the fund, uh, the registration process needs a net worth criteria to be fulfilled on the portfolio management, on the portfolio fund manager, and the application has to be made to the SEBI, which is the regulator. And the basis of the application, once the application goes to the SEBI and the SEBI reviews it, there's a due diligence done by the SEBI, and once the license is granted by the SEBI, the portfolio manager can go in and raise the funds which would be managed. Quickly touching based, there are two ways in which a portfolio management services can be run. So it's either can be done on a discretionary basis or can be done on a non-discretionary basis. I'll simply explain you the difference between them. So for example, I'm an investor and I give money to a particular fund manager. And if I give him money on a discretionary scheme, it simply means that the fund manager at its own discretion can go ahead and buy and sell stocks according to the strategy in which I am investing. Whereas on the non-discretionary, if a portfolio manager's fund manager runs a non-discretionary PMS, the difference is that the consent of the client or the investors is required before the portfolio manager goes ahead and buys and sells a stock. So, for example, if I've given a money in a non-discretionary portfolio scheme, and if there is a stock idea, the portfolio manager will either discuss with me or send me an email, and or will require consent from me before they go ahead and buy something for me in the scheme. And there is no restriction on the withdrawal of money by the investor at any point of time, and obviously it provides access to the different asset classes to the investors. There could be multiple strategies which a fund manager, based on his experience, can launch. So it could basically cater. It could be a concentrated portfolio. It could be a diversified portfolio. It totally depends on the fund manager to whom the investor is giving in the money. The PMS, once it gets the license, acts in a fiduciary capacity, and its license is valid for a period of 3 years. The minimum ticket size from an investor's point of view is 25 lakh rupees, and this can be in form of cash or maybe in the form of stocks. So if I'm an investor, and if I don't have money, but if you'd like to transfer my existing portfolio, which I've been managing on my own, and its value is more than 25 lakhs, I can even give that to the fund manager, and obviously fund manager can restructure it depending on the model portfolio or the investments which he or she would like to make. Again, as far as the investments go by, PMS can invest across asset classes in securities listed as well as unlisted. There is no concentration limits here, so there could be a PMS, and in the market as of now, as we speak, there are PMSs who are as concentrated, investing only in 5 or 6 stocks, and that is how they operate. And there are well diversified portfolio PMS schemes as well, which diversify. So it totally would depend upon the experience and the discretion of the fund manager. From an operational point of view, every investor comes at a different point of time, and has an individual demat account in which the stocks would reside. And it works simply. The taxation, the ownership of the taxation also is similar to how an individual would pay taxes on if he's buying or selling the shares directly. The responsibility of managing the risk of the portfolio totally depends on the portfolio fund manager, and obviously there is a detailed discussion when a portfolio manager goes ahead and signs up a client. So the investor understands the document on the scheme in which they are going ahead and putting in the money or giving the money to the fund manager to manage it. everything is crystal clear as far as the fees is concerned. So the portfolio manager can charge either basically annual maintenance fee, plus there could be a performance fee. So there could be as many permutation and combinations depending on the comfort of the investors. So this is the brief overview of the existing PMS regulations. What has happened recently? I mean, what I'll also do is that I'll quickly take you through a pictorial slide also, which just gives you, or will looking at it will help you with how the structure looks like. So this is the SEBI registered PMS pool account, basically which gets the license to pool in money and basically manage the funds of the clients. Obviously, there could be domestic investors as well as global investors. The fund manager manages the portfolio scheme, and as I mentioned earlier, that they can charge management fee and the performance fee depending on the fund manager. And the investors are basically the equity stocks. Usually, you see different fund managers having different schemes. As I said, that it would totally depend what scheme an investor is contributing the money. And last but not the least, a portfolio management services, usually most of the recent PMS schemes do appoint a professional custodian and a clearing member. The idea of appointing a custodian is to have an independent entity who would be safeguarding their assets. So just to give you an example and elaborate more here, just for the benefit of the new participants, Edelweiss is one of the custodians, and if we are a custodian for any PMS, what happens is that the demat accounts of the clients are opened with Edelweiss. So whenever the buying and selling of shares happen, the stocks will reside in the demat account of the client, which is operated by a custodian. And the safekeeping, all the corporate actions are taken care by the custody, and the settlement of the transactions on behalf of the PMS is also done by the custodian. So custodian plays a very important role, and all one needs to understand that investor can be rest assured that his assets are safeguarded and there's no issue if something goes wrong. So this is one important thing. The periodic reporting to the clients is done by the PMS fund manager and also to the SEBI on a monthly basis. The PMS fund manager needs to ensure there is a compliance officer who complies with the SEBI reporting and takes care of all the necessary documentation which needs to be done as far as the end client goes. So what I'll do right now, this as I said, that this is the typical PMS structure. Of late, there have been proposed recommendations on the current PMS regulations, and there's been a working committee which has come out with proposed recommendations. I'll now hand over the call to Shailendra, who will take you through the recommendations and touch it one by one on them.
Hi, good evening, everyone. Thank you, AIWMI, for giving us an opportunity to address the August gathering, particularly on the key amendments that have been taken place as far as SEBI PMS regulations are concerned. This has been a discussion in terms of as far as the PMS regulations are concerned for an amendment for a long time as regards the regulators are concerned. And probably we thought maybe this would be a right time to address some of the key changes, or probably educate some of our fund managers, particularly at this point of time. Although the timing chosen by us may not be apt amidst the given scenario. We are towards the end of a half-yearly closing, and we also have probably a longer weekend coming over. But nevertheless, I'll be your host for next 10, 12 minutes now, and then walk you through in terms of briefly what are the key aspects or changes that have been proposed by SEBI in terms of the PMS guidelines, followed by what are the eligibility criteria and the investment guidelines, which talks about to reframe and probably a 2-decade-year-old regulation. So we saw the regulation being amended sometime in 2008, and just walk you through that journey particularly. So the idea of SEBI to make an amendment was particularly in light of the context that considering the exponential growth in the capital market for over like maybe 5-6 years now, since the last amendment to the PMS regulations took place, there have been phenomenal growth as far as the AUMs are concerned, and these are particularly transcripts which you can find them into the working committee group recommendations proposed by SEBI on the PMS guidelines. So we saw the AUM growing 4 times nearly as compared to the earlier one in 2008, reaching as high as 18 trillion INR. Followed by the increase of the client pool base nearly 2 times as compared to the earlier comparison of 2008. So from a standpoint of a growth which is probably growing at a rapid pace, there have been concerns on the exposure as well as awareness as far as the particular information of PMS is concerned, and the way the PMS product has been of late being promoted by the fund managers. And therefore, the regulators failed to improvise the probably 2-decade-year-old regulation on the premise that, and especially to address and protect the investors' interest, followed by also to replace an old regulation and align them with the best practices internationally in terms of such kind of models, and similar and akin to what we see on a more structured format of FPIs or AIFs. So just to walk you through briefly the theme for the revised PMS regulation, which has been proposed for recommendation and which was available for public comments, is now closed as on 30th of August. And the theme which has been based for these recommendations have been to encourage transparency, particularly in terms of how the PMS functions, followed by the disclosure norms and so on and so forth, followed by particularly defining the role of the distributor who are the active participants to promote PMS. Essentially prescribe a disclosure norm. So there have been no disclosure norms which have been set, though we have forms and formats available. But the methodology with which it needs to be standardized is very important. Followed by, again, rationalizing the fee which are particularly levied by the participants who are involved in the PMS product. So it could be distributors, it could be the custodians, it could be particularly any of the brokers, and so on and so forth. There was also a need to have an efficiency built up in onboarding the PMS products per se within the investor and the client group. And therefore, there have been some subtle and key changes proposed by SEBI in this respect as well. And followed by standardization format as regards the reporting requirement is concerned, in terms of transparency of disclosures with the investor, followed by the regulators, for the investors to take an informed decision. So going to the next slide, so what the recommendations have provided is, whilst there have been no defined eligibility criteria for the participants involved in the portfolio management setup, what has been proposed in the recommendations have been qualifying criteria for the PO. So PO would particularly stand for the principal officer. And here, what has been, recommended is a kind of a broader criteria of twofold approach. So what we've seen is that the principal officer needs to be a professionally qualified, person, and followed by having a relevant work experience in and around this particular area where the investors or the clients are betting on their money with these fund managers. So from a standpoint, this has been recommended by SEBI to enhance supervision of the PMS in terms of operationalizing and identifying who are the qualified employees involved as far as the entire PMS setup is concerned. And what they've proposed is that a principal officer should at least have a minimum qualification or a professional qualification in the field of finance, law, accountancy, probably business management, including the CFA, and so on and so forth. And a tagged along condition would be that all these professional qualifications should be accompanied with a NISM certification. This is coupled with a relative amount of work experience in the securities market or the capital market segment, in the form of could be a PMS or probably a stockbroker or an investment advisor or a fund manager. So earlier criteria or the threshold for a PMS principal officer was was nearly 10 years. But on a need-to-need basis, these were relaxed by SEBI particularly. And this threshold of work experience has been lowered down. So it essentially allows young but professionals to set up the fund management activities under the PMS regulation. Besides the principal officer, what we've seen is that there are management personnel who are involved as far as the PMS setup is concerned. And this is again equally proposed under the recommendation, which says that in addition to the principal officer, we need to have a compliance officer, which was available in the previous regulations also. And additionally, they have provided a set of 2 employees that needs to be an additional part of the PMS group, having a similar minimum qualification threshold as that of a principal officer. Although the work experience of these employees have been further relaxed to 2 years. What has been prescribed is that in situations of certain employees who act as a quasi principal officer or who are the key decision makers as far as the fund management activities are concerned, they are obligated to have a same or similar qualification which has been prescribed for the principal officer, that is a professional qualification added with an NISM certification and a relevant work experience of 5 years. Interestingly, the regulations have proposed probably an additional burden on the fund managers, particularly operating under the PMS setup, to have a inflated net worth of around 5 crores as compared to 2 crores earlier. This is primarily on the fact, and the justification under the regulation or the proposed recommendation has been in terms of since 2008, which is a benchmark to compare, and that was roughly around 50 lakhs, which increased to 2 crores. That was approximately 3 times. But having said this, as on today, looking at the market depth, that just probably increased or reduced to an extent of 1.5 times as compared to the increase in 2008. so which is approximately 5 crores. Having said this, the net worth criteria for the new fund manager is applicable to the new fund manager or even for the existing fund managers operating under the PMS license. And for the existing PMS license holders, there have been a grandfathering available to the PMS license holder of approximately 12 months from the date of notification of the revised regulation to comply with the revised net worth criteria. So going down to the subsequent slide, here we simply walk you through and or probably the recommendations have evaluated looking at the per capita income of the country, followed by the extended activities as far as the capital market segment is concerned, and looking at the indices, which has grown phenomenally. What the regulators have proposed is to increase the minimum investment threshold from what Anand mentioned previously, from 25 lakhs to 50 lakhs. So this particularly has been related to only to the new funds that have been launched, or would apply typically in situations of the new fund managers who have obtained a recent license, or there are fresh investments which are being made as far as the existing PMSs are concerned. They haven't disturbed the existing investment threshold of 25 lakhs that remains intact till such time there has been a maturity which is attained for the investments of the existing PMS. So there's been no grandfathering, so to say, as far as the existing PMS thresholds are concerned. That's obviously a welcome change from the regulation side. Another important point to be noted is almost on the similar lines as that of mutual funds that we've seen, is that there are investment-based approaches which are adopted by mutual funds. So again, we see a lot of thematic funds, we see sector-specific funds, we see multi-cap fund, and so on and so forth. So almost on the similar lines as that of a mutual fund, an investment-based approach has been recommended to be adopted by the PMS fund managers. And here, every investment manager, every investment approach will have to be particularly designed or model based on numerous factors affecting the investment segment that the fund managers intend to target, to take care of the investor needs, followed by security specific factors like time zone, horizon, sectoral allocation, and so on and so forth, in order to particularly design and draft it into an offer document to be rolled out to the investor. This has been particularly more inspired from the mutual fund regulations, where we see a lot of NFOs coming over. So every new fund offer has got a prescribed document identifying the investment patterns and the risks. So whilst the recommendations do recognize that the PMS regulations are bilaterally approved by two parties, the PMS fund manager followed by the investor, to have a bespoke as far as their needs are concerned, there can be multiple investment based approaches that can be structured to take care of the needs of the specific investor group. Few important points to note as far as whilst an investment-based approach document is drafted, is that the recommendations provide a specific restriction to outsource the core PMS activities to a third party. And that has been a bit of dampener as what we have seen, although there have been enough further recommendations being made to dilute this particular proposition of outsourcing of the core activities in situations where there have been sub-advisory and researches being adopted from various fund managers. Another interesting point to note is on the investments of securities that can be made by a PMS license holder. Again, when you look at the earlier regulation prior to the recommendation, it has been fairly broad-based to include most of the securities. The recommendations have made the investments quite watertight to allow PMS fund managers to invest only in listed equities, debt, and probably derivatives, followed by units of mutual fund on behalf of the client. Unfortunately, the subtle difference that we find is the investment by the PMS in the unlisted space has been restricted, and it also does not find space as far as investment activities, as far as quite prominent investment asset classes at the moment in AI units of AIF, or for that matter, REITs and InvITs. So that has been a recommendation from the industry group to include such varied asset classes to diversify the portfolio of the PMS fund manager. Similarly, there have been practices in the past by PMS fund managers to permit mutual funds investments of the investor group in the identified, either in to attain or probably achieve short-term liquidity, or for that matter strategic investments into the mutual fund group that particularly have been so-called restricted to an extent that yes, the PMS can permit their investor group to invest into the identified mutual funds. But this will happen now under the direct plan without attaining any distribution or commission or a referral fee. So it is only the performance assessment that can be evaluated whilst the investor group invests into the mutual fund through a PMS license. Taking you through the subsequent slide, which talks about particularly more of standardization of performances, which my colleague Krishnan will also walk you through the nitty-gritties in terms of the reporting format. But what I would like to briefly touch upon is the genesis with which the standardization of method, which has been referred in the recommendation, is primarily on the performance return computation side. And evaluation, especially to share, accurate information that can be transparently, disseminated to the investor. And the need for that was probably arising owing to multiple reasons. So one was primarily to reflect the actual returns than the model returns, which has been the adopted practice of the PMS. Followed by, there were no static methods to compute the return. There have been, observations from SEBI in terms of selective reporting and disclosures being made on the performance returns by the fund managers, and followed by the performance returns, adopted varied methodology to recognize realized gains and not to, capture the unrealized gains. It was also coupled with, upfront expenses not being regarded as an allowable expenditure to compute the performance return per se, following certain accounting practices, and therefore it used to give a distorted picture as far as the returns to the investors were concerned. So owing to multiple reasons, the recommendations saw the need to standardize the computation method of deriving a performance return transparently to the investor, and probably it can be categorized into four areas. So one is the performance calculation. So here the the recommendation has been to compute the returns on a time-weighted rate of return basis, which is more of a globally accepted formula or principle to determine the return, excluding certain exceptional situations which have been, beyond the reach of the PMS fund manager. This should also typically include the withdrawals as well as timely infusions of funds of investments. So that's the predominant formula with which TWRR method, commonly known as, should be adopted. Followed by the TWRR method should also include all the cash and cash equivalent liquid funds invested by the fund manager, and the performance return that needs to be computed should be on a net of expenses and tax basis, which gives a true picture in terms of what's the absolute return that the investor can make out of their portfolio at the moment. This is followed by standardizing the format or the template for reporting frequency. And probably I won't take much time on this because it will be amply covered by my colleague. But let's look at one of the important aspect here is in terms of the change in the approach and investments, especially when there has been an amendment to the fund manager who are key in nature. So here is a disclosure or reporting requirement which contemplates the change of the fund manager to be captured and amply disclosed to the investor group, followed by the change needs to be notified to the regulator and the client within a prescribed time period of 1 week of such change. And essentially to also highlight the amount of impact that it would cause as far as the investments are concerned when there is a change of control as far as the fund management activities are concerned. There have been another set of standardization format as regards the marketing document which is used to solicit the PMS products are concerned. So one important viewpoint here is to bring in parity between the performance that has been reported as far as the existing PMS returns are concerned in the marketing material vis-a-vis the website is concerned, similar to what has been reported to SEBI. So there have been, probably a slew of discussions on this point that the returns have to be amply disclosed to the investor in a harmonized manner. So there have been an attempt to do that from the regulator, which suggests that the marketing material followed by the website and the reporting which has been done to SEBI should be harmonized to reflect the true returns to give for an informed decision to be made by the investor. Here, important point to be also noted is that the performance should be truly audited, self-certified by the authorized person of the PMS to take care of the standard performance reporting requirement, and an additional disclaimer that needs to be provided over and above the comprehensive disclaimer that we've seen in most of these capital market products is that and that has been recommended, is that a mandatory disclaimer to provide that the performance information is not particularly verified by SEBI, though it has been shared with the regulators in a reporting format. Going down to the next slide, we simply talk about the intermediary who gets extensively involved or exchanges various information as far as the PMS products are concerned, the distributors particularly. And here the regulators, including the parties involved, the stakeholders, had a concern that there was no specified contracts or guidelines prescribed for the distributors who will be to particularly govern the distribution of the PMS product. Followed by, there was no prescribed code of conduct which used to take care of the disclosure norms involved as far as promoting these or soliciting these PMS products by the distributor. And especially there was a need for to prevent mis-selling or have misinformation done as far as particularly by the intermediaries to sell the PMS products. So taking care of these particular highlights, what has been recommended and finds its place in the first time as far as the PMS regulations are concerned would be a qualifying criteria for the distributor who would be sole selling the PMS products. And particularly what has been provided is that the distributor group, including the employees, should have a NISM mutual fund certified license followed by the distributor, or can also have a registration of ARN prescribed by AMFI till separate certification for PMS distributors have been conducted, and so on and so forth. Importantly, is also provided in the supervising of distribution activities are that there has been an introduction of the formal code of conduct provided into the annexure A3, which is probably taking care of the investors' need, particularly to make the the information more transparent as far as these products are concerned. And the onus surprisingly has been on the PMS to ensure that the code of conduct has been complied with by the authorized distributor. Without taking much time, I think, as I mentioned earlier, the larger interest of introduction of the supervision in the distribution activities have been to prevent any mis-selling, conflict of interest, and so on and so forth. One important change that I wish to highlight is that that the distributor obtaining commission as far as selling the PMS products, which was earlier on an upfront basis, have been proposed to be on a recurring basis, particularly depending on how the performance of the PMS have been, as far as the investor group is concerned. So with that, probably I'll hand over the discussion to my colleague Krishnan, who will take you through as far as the reporting and the disclosure norms which have been prescribed in the recommendations are concerned. Over to you, Krishnan.
So thanks, Shailendra, for giving us an insight of the overview of the SEBI regulations. So I would take you guys through the disclosure and reporting changes. Let's begin with the changes suggested in the disclosure document requirements to SEBI and the clients. So as per existing regulations, currently the disclosure document needs to be furnished to the client at least 2 days prior to signing the PMS agreement. So this used to be very cumbersome and it was very difficult to maintain an audit trail for the portfolio managers. So this requirement has been discontinued by SEBI. So that's a positive change. So going forward, this document needs to be furnished any time before or at the time of entering into the agreement. And the soft copy needs to be made available on the portfolio manager's website at all times. Now coming to disclosure document requirements to SEBI. So as per existing regulations, we have various stages at which this needs to be submitted. Initially, you submit, to SEBI before any document is circulated to any of the clients, and thereafter every 6 months. And thereafter, every 6 months, it needs to be furnished. So this requirement of 6 months, the working committee realized that this requirement for submitting every 6 months, normally there is no changes. So very rarely there is a taxation change or any critical change. So this requirement of submitting every 6 months has been done away with. So currently, only if there is any material change in information, the same needs to be filed with SEBI, and this needs to be done within 5 working days. There are a couple of more changes which has been suggested. One is with respect to conflict of interest related to services offered by the group companies. So in the existing regime, we have nothing of what any services offered by group companies or associates. There is no mention. So going forward, this needs to be compulsorily reported in the disclosure document. Next is the risk associated with each investment approach. So in the existing regime, we don't have something like investment approach, which has just been adopted in the revised guidelines. So going forward, we need to maintain risk associated with each investment approach in detail in the disclosure document. Now moving forward to the reporting piece. So the reporting piece is basically being covered into two. One is reporting to the regulator, and second is the reporting to the end investor. So in the existing regime, normally the portfolio managers have different ways of computation of returns, based on model portfolio or based on time weighted rate of return, etc. And different methods are used by different portfolio managers, and there is no standardization. So one method is disclosed to the regulator. There's a separate method which is disclosed to the end investor. So going forward, the working committee has recommended a standardized method of computation of performance returns. And this needs to be, on time-weighted rate of return and net of all fees and expenses on a consolidated performance basis for each investment approach. So earlier, we were combining the returns across all investment approaches, and one consolidated return was being circulated. However, now, the fund managers are better placed because, you may have, say, a small cap fund, or you may be having a banking fund or a multi-cap fund. So you can show different performance returns for each of those investment approaches, and the same approach needs to be highlighted in your regulatory reporting as well as your client reporting. So there's the standardization which is required, and this approach has to be on the weighted average of client AUM. Now coming particularly to the half-yearly reporting requirements. So there are basically 4 changes which has been prescribed. The first is an addition where the commission paid to distributors currently has no mention in our existing guidelines. So going forward, as part of the half-yearly reporting, we need to add the commission paid to distributors. There are 3 exemptions which has been given in the half-yearly reporting. One is the requirement for a suspended or defaulting broker. So this was a very tedious task for all the PMS, where it is very difficult to get the list of defaulting brokers. So going forward, the portfolio managers only need to give the list of active brokers. Second is with respect to disputes and litigations. This requirement also has been exempted. Third is with respect to the names of corporate clients. So this is again a very tedious activity where the portfolio manager needs to give the list of all corporate clients, and which did not serve any purpose. So the working committee has decided to exempt this requirement. So going forward, you need not mention the names of corporate clients. Now coming to the monthly reporting. So the first important change is the reporting deadline. So the existing deadline of calendar day 5 becomes very tedious, and with any business days or any public holidays in between, it becomes very tough to meet the deadline. So that's a positive change. The reporting timeline has been revised to 7 working days. Now coming to the annexure of monthly reporting. So there has been a complete revamp in the reporting guidelines. So in the existing monthly report, normally we are giving all details of whether it's a individual retail client or a resident or non-resident, and the count of investors is given. You're also giving asset class breakup of the AUM. All these changes have been, all these requirements are no longer required. In the new method of computation and the new working format, you only need to give for each investment approach what is the AUM and the returns across for each investment approach. In addition, they have also introduced the requirement of standard deviation to be identified for each of the portfolio for the respective periods. So standard deviation is a new concept, which obviously due to the risk and to measure the volatility in the portfolio, the SEBI has introduced the same. Now moving to the next slide. So we move to client reports. So as per our existing regime, the client reports need to be given to the clients at least once in 6 months. So this has been brought down. So going forward, the portfolio manager needs to send the client reports at least once in 3 months. So as far as the industry benchmark is concerned, I think it's not a new requirement. We are already sending, most of the portfolio managers are already sending on a monthly or a quarterly basis. So there's not really a change on the ground. Again, the client computation method of the returns would be on TWRR method. So there is a complete standardization across the client and the regulatory reporting. In addition, the commission paid to distributors needs to be also mentioned in the client reports. Now coming down to the next point, which is the fees and expenses. So our existing PMS regulations is completely silent as far as the fees and expenses is concerned. There is no cap on the amount of operating expenses which can be charged. So something like a mutual fund, is heavily regulated in terms of what management fees it can be computed or what are the other operating charges. So some of the key changes which has been introduced, the first and foremost is the distributor commission paid. So the distributor commission paid can only be on a trail basis. You cannot have an upfront commission. Secondly, in terms of operating expenses, you have a 50 bips cap. So operating expenses cannot exceed 50 bips. This is obviously excluding the management fees and brokerage, which will be over and above the operating expenses. So that's a good news again. So there is no cap on the management fees which the portfolio manager can charge. There is also sub-limit into the custody fees which can be charged. So custody fees are currently capped at 10 bips as per the revised guidelines. Also, there is a sub-limit on the audit fees and notary charges, franking, etc., which cannot exceed 25 bips. The broking charges would obviously be at actuals. So another significant inclusion is to restrict related party transactions to 20% per associate per calendar quarter. And this has to be on an arm's length principle. So the working committee has seen a lot of transactions, especially broking transactions being given to associate brokers. So unlike mutual fund industry where there is already regulation in place, now the new regulation has been introduced to cap the amount of business you can give to related parties or associates. Now coming to performance fees computation. So far in the existing regulations, there is only mention of high watermark. So within that, the portfolio manager and the end investor can have any kind of agreement, different ways of computation performance fees. So there is no restriction. And even in the revised suggestions, you are free to have your independent bilateral agreements. However, the performance fees should be charged without catch-up. So in the current regime, we are having different portfolio managers having different methods. So some are like they are having full catch-up method, or some are having partial catch-up method. So what SEBI has proposed, now going forward, performance fees has to be computed on without catch-up basis. That is the amount which is over and above the hurdle rate. So only over the gain, over and above the hurdle rate, we will be charging the performance fees. Now coming to the exit load. So currently again there is no restriction on the amount of exit load which can be charged. So SEBI has come out with a cap. So maximum which you can charge is 3 years, and after 3 years there cannot be any exit load. Now coming to the reporting, as far as the client agreement is concerned. As part of the client agreement, now currently we have illustration of fees and expenses for the sample portfolio. So what SEBI has recommended, that this sample portfolio should be for the minimum investment value, that is 50 lakhs. And the existing requirement, of the client signing manually that he has understood the fee structure is no longer required. So this eases a lot of pain of the onboarding process. So currently everything is manual in onboarding due to the signature requirements and this handwritten rule where the existing client needs to sign on the PMS agreement that he has understood the fee structure. So by this removal, this brings automation into onboarding, where digital signatures can be used to validate the digital documentations. Now the custody need to accept digital signatures for account opening and eliminate signing across photograph, physical signatures across IPV, and the mandatory handwritten statements. It is also recommended that the SEBI should work with the state government and see if the franking and notarization can be digital as well. So with this, I have completed the reporting and disclosure reporting requirements, and I hand it back to my colleague Shailendra, who will take you to the key takeaways. Thank you.
Thank you, Krishnan, for an elaborate discussion on the reporting and the disclosure norms prescribed by SEBI. Thank you, participants, for your continued support. Very quickly, in terms of any questions that you may arise as far as our discussions are concerned, feel free to write them into a chat box and we will try and address them as far as possible during our Q&A session. Briefly, whilst we've gone through the key changes which have been proposed by SEBI in their recommendation to further improvise the PMS regulations, what we see as a quick impact and which has been forming part of the recommendations of various committees and forums to SEBI, where SEBI has introduced a consultation process to probably introduce the regulation with the relevant stakeholders before formalizing them. And some of the key areas that were concerned by the fund managers and what we've tried to address them, rationalizing to the regulators is in terms of probably the new recommendations would create a sense of high burden on the professional experiences that will be obligated or required to have professionals on board as far as the fund management activities are concerned under the PMS regulations, followed by a high threshold of the net worth criteria, which has been increased multifold from 2 crores to 5 crores. This is followed by the roles and responsibilities that will be obligated to be defined for a quasi principal officer who are under a delegated mechanism of taking decision or fund management decision making authority under the PMS regime. The proposed recommendation also involves an employee-heavy model, because as of now, under the proposed recommendation, you have a set of 4 employees that needs to be deployed as far as a particular license under the PMS is concerned, which is quite burdensome as far as the industry practices are concerned. And followed by some of the onerous conditions, especially when you look at the distribution methods which have been revised, or the supervisory guidelines prescribed for the distributors per se. There have been a lot of onerous conditions of code of conduct imposed on the PMS to ensure that the distributors comply with the relevant code of conduct. This is followed by what my colleague mentioned was in terms of the removal of catch-up for computing the performance fee, particularly when this has been fairly adopted and formally adopted in the international practices, including the AIFs that we've seen. And also in terms of introducing capping of interrelated expenditure, which would particularly involve multiple intermediaries to ensure that the expenditure capping is maintained in situations of related party transactions, even though they are on an arm's length basis. And this is also followed by the outsourcing guidelines, which restricts the ability of the PMS to rely on an expert's view to particularly undertake investment activities. So that is something which multiple forums or industry committees have made a recommendation to consider a dilution in this particular respect. This is also followed by finally limiting the investment activities as far as asset classes are concerned, especially when most of the asset classes like AIF, InvITs, REITs are particularly intertwined as far as PMS diversified investment attributes are concerned. And that should be relaxed. So maybe as a suggestion is in terms of amending the SCRA definition and include most of these securities for making investments under the PMS regime. So quick, sum up, or rather futuristic outlook that needs to be, tracked as far as the PMS regulations are concerned. In the subsequent slide, we've got some pointers that needs to be looked at. Is one, await for the formal introduction or the guidelines of the PMS regulation. And this is for the first time we've seen the recommendation coupled with the amended regulation of 2019. Whilst the entire process is through a consultation from various stakeholders, it is to be seen as to how and what are the recommendations made by various committees get incorporated into the recommendation and is formalized. Followed by an interesting attribute would be that the PMS particularly is restricted to invest or manage funds of its investors or clients offshore. And what we have seen is that the SEBI is contemplating, though the enabling provisions have been provided, SEBI is contemplating operating guidelines as far as PMS in IFSC is concerned. This would be also followed by encouraging measures, particularly which is when you compare it with the AIF or the FPI regulation. So FPI regulation as an update has undergone a series of change as far as the regulations are concerned last week. And probably to adopt the similar best practices, it would be appreciated if similar such practices get introduced in the PMS regulations. Followed by, there has been always an expectation of permitting leveraging as far as the PMS regulations are concerned, though it is the leveraging of portfolios find its place into the present regulation into a diluted form, but a full-fledged leveraging concept, if through certain restrictions may be introduced, it would definitely increase the activities of the capital markets are concerned. And followed by what my colleague earlier mentioned was in terms of alternate measures, particularly to promote the PMS industry, would be offering, similar tax concessions, what we've seen in IFSC, which has been proposed in the recent budget, and probably, enhance operational ease. So with this, I hand over the session to my colleague Anand to provide his final comments.
Thank you, Shailendra. Before we open we open the house for the question and answers. I'll just take a minute and quickly harp upon our offerings here. As I mentioned, Edelweiss is one of the custodians and a fund accountant provider. We are one of the custodians, and we're a one-stop shop where we help anyone who wants to set up a PMS as to how to go about structuring it and how to go about making an application to the regulator. And once the fund gets the license, we act as a custodian and a fund accountant for the PMS. As I said, that this is one of the important points. We, as of now, have 30 PMSs clients for whom we act as a custodian and as a fund accountant also, and help them with the statutory compliance and the reporting which needs to be done to the SEBI. Obviously, Edelweiss is a platform. The PMS can also take advantage of the research platform which Edelweiss provides. So thank you so much for this. We will open the house for question and answers. We have been getting questions right now. We'll just try to take 5-6 questions because of the scarcity of the time. And any further questions, you can email to my colleague Prachi, whose ID is mentioned in the invite which you would have got. I'll just repeat the ID. It's prachi.chaudhary@edelweissfin.com. So in case we just miss out answering your questions. So the first few questions are there. We'll just wait for some more time, basically for the questions to come out. So we will start with the first question, which we have from Snehil from Soldier Fields. His question says, and this is for you, Shailendra, are these regulation proposals set in stone now, or is there a feedback to SEBI which is still possible?
Thanks, Nehil, and this is quite an interesting one that we've been, occasioning multiple amount of times when the time frame of these questions have been elapsed. So, whilst the time frame was 30th of August 2019, if there are key recommendations which would impact the business proposition of the PMS fund manager, that on the sidelines can always be recommended through a formal note to SEBI. So that's the way one can articulate till the time the regulations get formalized. And what we've seen recently is that the regulators are pro-business and investors. So considering a situation which will definitely impact the business of the fund management activity, they would be more than happy to consider them and amend them in the form or clarify them in the form of an FAQ or carry out an amendment if required.
Thank you, Shailendra. So the second question is, could one person play both role of principal officer and fund manager? So Shailendra, you can answer that as well.
So yes, as far as the key recommendations are concerned at the moment, there have been no introduction of a one-person concept introduced. At the moment, this is quite a laid-down structure as far as the principal officer, the compliance officer. At best, the way it could be read is that particularly the fund, since it has been provided that the fund management activity can be outsourced to an authorized representative, it is perceived that the principal officer and the fund manager would typically remain the same. So that could be a better view with which it can be certainly considered.
So there is another question from Madhu, and she has asked is investment in direct mutual fund plan is a bit difficult, since in this case the PMS will not get data from AMC to update the transactions if the investment is under direct plan. So just to answer this, Madhu, it is nothing to, do with the new regulations. However, what happens currently is what we have seen from the clients which invest in mutual funds. There are clients who have been investing in the direct mutual fund plans, and obviously they get the data from the fund houses. So it's not on time, because there are different fund houses who sends the data on different time, but there's a way how the transaction can be executed. We will get in touch with you offline and elaborate more on this to you. So there's another question from Amit, who has asked, first question is the industry feedback on the probability of increasing the ticket size to 50 lakhs this time. This is the first question. What is the probability of increasing the amount to 50 lakhs this time? Second question is, in terms of the restriction on type of securities to the listed ones and the mutual funds, can one invest in global securities as per the new recommendations, or is it restricted to the India only under the PMS? So Krishnan, you can answer this.
Yeah, so as far as the industry feedback is concerned, so obviously, they would still like to continue with the 25 lakhs because you can cater to more clients. However, looking at the feel of SEBI, it doesn't seem they are going to roll back this because they want to increase the risk and they want to keep the retail away from it. So, it's unlikely that they will roll back this recommendation. Second, coming to the second question, where you're asking about restriction of global securities. So current guidelines are quite silent. There is nothing mentioned, whether it is going to be restricted or no. So, it's quite a gray area. Nothing has been mentioned, and it is not restricted means it's permissible. We can go by that logic.
Thanks, Krishnan. So we have a couple of more questions coming up. Just wait for a few more seconds. So there is another question from Snehil for Krishnan. Krishnan Snehil is asking basically, since the client funds are not commingled with the PMS balance sheet, what is the logic for the high net worth requirement other than as a filtering mechanism for entrepreneurs and favoring established business houses? So is there, any reducing investment risk for the clients?
It's a very valid point. By increasing the high net worth requirement, there is no way you're evading the risk, or you never know whether the portfolio manager is serious or not serious. But this is how it goes. It defies logic actually. But even previously they had increased the net worth, and they had brought it to 2 crores, and now currently they are planning to bring it to 5 crores. So it's a very valid point that increasing net worth, doesn't reduce investment risk for clients.
Thanks, Krishnan. This is the last question which we'll be taking up. And as I said that if you have any further questions, so you can email us, email the questions to prachi.chaudhary@edelweissfin.com, and we'll come back to you shortly on the same. The last question is from Weber, who has asked that will research analyst experience in a PMS qualify as an experience as a portfolio officer? To which Weber I would like to just briefly mention is that it totally depends on the number of experience which the fund manager has. And obviously, once the application is made, if you go through the suggestions or the PMS regulations, it clearly defines what broadly should be the experience for the fund manager. So a fund manager might have been a research analyst in his previous avatar, but obviously there would be other factors, whether he has managed funds at some point of time during his tenure, apart from being a research analyst. So there are sell side analysts, there are buy side analysts. So it would totally depend on many other factors and not just being a research analyst. If Shailendra, if you would like to add something to this.
Yeah, I think Anand summed it well. Just to quickly add on would be that the related recommendation provides a professional qualification as well. So whilst it is respected, and as far as the research analyst experience would certainly count for the prescribed WorkX to comply with the principal officer of the PMS, there are add-on conditions. So in addition to that, a professional qualification followed by an NISM certification would be a prerequisite. So from that standpoint, and where there has been a work experience contributing towards the portfolio management or stock broking activities actively or even dormantly, I think from a WorkX standpoint, it should qualify.
Thank you so much, Shailendra. Thank you everyone for the participation. We are happy to address any of your queries going forward. Just to reiterate that the regulations or the suggestions have not been finalized. SEBI is yet to come out with the new regulations implementing some of the suggestions which have been suggested by the working committee. So we'll keep you posted as and when the new regulations are out. Thank you so much.